Okay, Assalamu alaikum everyone. This is Sheikh Bilal Haq. In the last class, we have discussed the return on capital employed ratio, the return on sales ratio, asset turnover ratio, current ratio, quick ratio, inventory days ratio, receivable days ratios, and payable days ratios. So in today's class, what we will be discussing is we'll be discussing the measuring of risk or risk oriented ratios. Now, what are the risk oriented ratios? Risk oriented ratios are moreover concerned with the paying off of the long term liabilities or long term debts. Now, let us watch or let us see what these ratios have to tell us about. Measuring risk. In addition to managing profitability, liquidity, and activity, it is also important for a company to manage its risk. How geared the business is can be calculated to assess financial risk. Okay. So in order to assess the financial risk, you need to know how geared the business is. Now, what is the meaning of geared? So what do you actually mean by geared? Now, let's see. By the word gear or gearing ratios, see, in the last class, we had seen the current ratio. The current ratio depicted the current ratios basically depicted that how geared our company is in regard with the current liabilities that we have to pay. For every 1 rupee of current asset, how much liabilities do we have? Now, in gearing ratio, it states that gearing ratio basically depicts about the company's possibility of paying its long term debt. Moreover, if I replace this word possibility to the company's ability of paying its long term debt, how much company, how much assets or the total equity that is available for a company is available in regard with paying the long term debt of a company. Now let us discuss how will this ratio be calculated. Let us draft an example. First, let us see what this ratio is about to tell us. The ratio calculates the relationship between the borrowed capital, that is the debt, or an owner's equity. See, we basically use the second formula. So let us discuss the second formula. Capital gearing ratio is equal to the non-current debt, that is non-current liabilities, divided by the non-current liabilities plus owner equity, that is debt plus equity. Okay, so in order to draft the gearing ratio, we first need to look what this gearing ratio can be stated in what format. Gearing ratio is equal to, let's suppose the gearing ratio can be seen in the format of, let's suppose, the non-current, sorry for my writing, but I guess you guys must be hearing what I am writing, so you can note down things that I've told verbally as well. So non-current liabilities divided by non-current liabilities plus shareholders equity. Okay, so this is the formula that we will be using in order to calculate the gearing ratio of a company. Let me draft an example. Let me draft the financial position of a company, and let us concentrate on the entire ratios, on the entire set of ratios that we have studied right now. So let's suppose I'm drafting the financial statement of one of the leading companies of Pakistan. Let's suppose I'm drafting the financial statement of SBH company. SBH company, SBH is basically my name, Sheikh Bilal Haq. So my company's financial statement is being drafted. Statement of financial position as at 31st December 2019, I'm drafting the financial statement of a company so that we can find out the entire profitability, measuring risk ratios, each and every ratio that we have discussed. Acha, if you want to review the previous ratios that we have studied, that is return on capital employed, return on sales, return on sales, asset turnover ratio, current ratio, quick ratio, inventory turnover, inventory days ratio, receivable days ratios, and payable days ratios. All 7 ratios that we have discussed, 7 to 8 ratios that we have discussed. You can go to my previous lecture. You can see over there what I have stated about those basic ratios. And today, what I'll be doing is I'll be drafting a question. You will have to pause your video and you'll be calculating each and every ratio that we have studied right now, that we have studied up till now, basically. So let me draft. The first and the foremost thing that I'll be having is the assets of the company. In fact, let me make it more clear and prominent to you guys so that it becomes easy for you to basically record it. So what I suggest is, while reviewing these lectures, make sure that you have a notebook and a pen, and you can basically calculate it by yourself as well. So, because without practicing yourself, you won't be able to get the inside knowledge of the ratio, or you won't be able to justify your answers. You won't be able to predict your answers in the exam scenario. So assets of this company constitute two different types of asset, that is non-current and the current assets. Let's suppose the non-current asset constitute building, land, machinery, and vehicle. They are all on book values. Let's suppose the building, or let me write the book value because we are drafting a question of ratio, so I can directly write the book value. Let's suppose the book value of building is 200,000. And the book value of, the face value of the land is 100,000. Machinery constitute 50,000, and vehicle constitutes 1,50,000. So this makes 200, that is 300, 4 and 500,000 for the entire set of non-current asset. Let me make another column. Now let us see what current asset do we have. What are the current asset of this company? So while reviewing the current asset of this company, the company have stated that we have got some closing inventory, which is 50,000. We have got some receivable, which is 30,000. And we have got cash, which makes 1,20,000. So 120, 150 and 50, 200,000 is my value of, 200,000 is the value of, 200,000 is the value of the current liability. So in altogether, I have got 5, 6, 700,000, the value of my total assets. Total assets makes up 700,000. So this is something which can be seen from the asset side of the company. So now I'm going to draft the liability sides and the equity side. Liabilities of the company constitute two types of liabilities: non-current liabilities and then current liabilities. Let us make two column again. Non-current liability, we only have one single type of non-current liability, that is bank loan, which constitutes 5,20,000. 5,20,000 of loan that we have. Now let me draft the current liabilities. Let's suppose the current liabilities of a company is accounts payable, rent payables, and interest payable. The accounts payable of our company is 70,000. Rent payable is 10,000. And interest payable is 30,000. So this makes 70, 80, 90, 100, 110, 110, 000 of current liabilities. So the total liabilities of my company is 30,000. 6,30,000. Achha, let us change this value because bank loan is way too much. Because I guess equity amount should be more than the bank loan. So let us make this 2 lakh in order to get a good answer, an answer which shows a more realistic approach. So 2 lakh of bank loan, and if we add up 2 lakh and 1 lakh 10,000, so I'll be getting an answer of 3 lakh 10,000 rupees. Now, I don't know why this stylus is not working well, but I'm trying to make it good. Okay, so 2 lakh and 1 lakh 10,000 will give me an answer of 3 lakh 10,000. 3 lakh 10,000. Now, the third part, the next part of this liability and equity portion, in fact, what we are calculating right now is the liability and equity. This entire portion is known as the liability and equity portion. So let me draft the equity portion. How will we be drafting the equity portion is, okay, so ordinary share capital. We only have ordinary share capital in our equity section. So the ordinary share capital given by the question is, let's suppose the ordinary share capital constitutes 3,10,000. 3,10,000 minus 7 lakh will give me an answer of 3,90,000. 3,90,000 rupees is my ordinary share capital. So the total amount of total equity and liabilities are 7 lakh. So this gives me a clear depiction that my total assets are equivalent to the total equity and liability. Together with this, in order to find out all different ratios. Now see, I'm just drafting a question by my own self. So I need to be very close and very clear in this regard. So let me find out what other values should I give in order to find out each and every ratio that we have studied up till now? Okay, so I need the value of operating profit. I need the value of capital employed. So capital employed, we can calculate basically capital employed by using a formula of adding up. Okay, so I need to calculate the return on capital employed. And in order to calculate the return on capital employed, I need to give, in this particular question, there should be the value of operating profit. Non-current liability, total equity is already been provided. Okay, so I need to give the value of sales. Together with this, I need to give the value of gross profit, that is operating profit. Along with this, current asset and liabilities have been given. Inventory, current asset, liabilities. Okay, inventory. I also need to give the cost of goods sold. There should always be value of credit sales. There should always be value of payables and credit purchases, receivables. Okay, well and good. I can go back to my question and I can draft my question. Okay, so here I have got, I've given the value of credit accounts payable, and I've also given the value of accounts receivable. So what other information I need to give is other information that I need to provide is the sales is equivalent to 3 lakh rupees. The cost of goods sold is equivalent to 2 lakh rupees. So the gross profit, sorry. The gross profit of the company is 1 lakh. Operating expenses I guess I need to change the value of cost of goods sold. Let me keep this value as 50,000 because, okay, so 50,000 minus 3 lakh will give me an answer of 2 lakh 50,000. Operating expenses are, let's suppose, 100,000. So the answer of operating profit is 1,50,000. Together with this, the company has also told us another information, that is total sales constitute 50% of credit sales. And number third information is total purchases for the year, considering what is the payable amount that I've given. Okay, the payable amount is 70,000. So total purchases for the year is, okay, 80,000. Don't get confused by the fact that why the cost of goods sold is less than the total purchase. It can be less than because there might be a fact that the closing inventory is more than the amount that we have. The closing inventory is more than the amount that we have purchased. So 80,000 rupees. Let me make this 80,000 very clear. 80,000 rupees is your total amount of purchases, and you have been given the value of credit purchases as well, accounts payable as well. Accounts payable you have been given, accounts receivable you have been given. Now, the requirement of this question is, I'll be calculating each and every ratio right now. Calculate, number one, ROCE. Number two, return on sales. Number 3, asset turnover. Number 4, number 4th is the current ratio. Number 5th is quick ratio. Number 6th one is inventory days ratio. Okay, so the 7th one that I need to calculate is receivable days ratio. 8th is payable days ratio. 9th one is capital gearing ratio. So you need to calculate all these 9 ratios. Do one thing, pause this video, calculate these 9 ratios, then come back to this video and compare your answer if you have calculated it right or wrong. I'll also be giving you the interpretation of each and every ratio that we have calculated. Now, the first and the foremost ratio that we need to calculate is the return on capital employed. Let us see what is the formula of calculating the return on capital. Let us revise what is the formula of calculating the return on capital employed ratio. Okay, so the return on capital employed ratio may be calculated by using one of the most simplest form of formulas, that is, okay, so return on capital employed, measuring the profitability. Return on capital employed is equal to operating profit divided by non-current liabilities plus total equity or the capital employed. So let me draft this formula right now. The first formula that I'm using is return on capital employed. So the return on capital employed, ROCE, may be calculated by using the formula of operating profit divided by capital employed. And you guys are well aware that we have been given operating profit as, I'll be using a different pen so that I can highlight things. 1,50,000 is our operating profit. 1,50,000 is our operating profit. So our operating profit is, our operating profit is 1,50,000 is our operating profit divided by capital employed. Sir, what is the formula of calculating the capital employed? Let me write this formula over here. We can calculate the capital employed by using non-current liabilities plus owner equity. So can you show us this formula? Non-current liabilities plus owner equity is the formula of calculating the return on capital employed. Let me find out the return on capital employed then, or ROCE. So we will be dividing 1,50,000 whole divided by non-current liabilities. Sir, what are the non-current liabilities that we are given in this question? We have been given 5 lakh rupees of non-current liabilities. So we have got 5 lakh rupees of non-current liabilities plus the owner equity. What is the owner equity answer? 3,90,000 on of owner equity plus 3,90,000 of owner equity. So I'm getting an answer. If I add up 5 lakh, if I add up 5 lakh the plus 390, so I'll be dividing 1,50,000 whole divided by 8,90,000. So the answer that I'll be getting is 1,50,000 divided by 8,90,000, 0.16, or multiplying by 100. So answer that I'll be getting is ROCE is equal to 16%, which means that if I interpret the answer, is 0.16 means for every 1 rupee of capital employed, you are just generating 16 paisa of operating profit. So the clear depiction of this answer will be for, okay, I'm using another pen so that you can differentiate between what I've calculated and what I have interpreted. For every 1 rupee of capital employed, we are generating 0.16 rupee or paisa of operating profit. So this is the answer of return on capital employed, sir. I have calculated the first requirement of this question, that is return on capital. Now let us come to return on sales. Sir, how do we calculate return on sale? Let me find out the formula that we use in our last class. That is operating profit divided by revenue. Now let us find the return on sales. Again, pause this video, try finding out yourself, and then come back and verify your answer. Okay, so the second formula that we'll be using is return on sales. How do we calculate return on sale? Is ROS is equal to operating profit whole divided by the value of sales. So what is our operating profit? We have been given operating profit. We have also been given sales value. We have been given operating profit value. So the operating profit is 1,50,000. I guess 1,50,000. And the sales value is 300,000. It's a very clear answer. 300,000 multiplied by 100. I'll be getting an answer. 1,50,000 divided by 300,000, 0.5, which means 50%. Always remember one thing. Whenever you are calculating the ratios, you'll go from denominator to numerator while interpreting the answer. So for every 1 rupee of sales made by the company, the company is generating 0.5 rupee of operating profit. So up till now, this is quite prominent from the company's operation, that for every 1 rupee of capital employed, we are generating 16% of the operating profit, and for every 1 rupee of sales that we do, we are generating 50% of the operating profit. So up till now, we have calculated two different ratios, return on capital and return on sales. Now come towards asset turnover ratio, one of the most beautiful ratio in order to get to know what is the asset related interpretation in regard with this particular company. So I'm calculating the asset turnover ratio. Asset turnover ratio may be calculated by using this particular format or formula. So asset turnover may be calculated by using the revenues divided by capital employed. What is the amount of revenue that you generate? Asset turnover is equal to revenue divided by capital employed. Okay. So the revenue of the company is, I guess, 3 lakh rupees. Yes. 3 lakh rupees is the revenue of the company. And the capital employed amount is, the capital employed amount right now, we have calculated in our, okay, this is the amount of capital employed, that is 8,90,000. 8,90,000 multiplied by 100. The capital employed basically means the total amount of capital that you have invested. Either it may be in the form of equity from your own point of view, from your internal company's perspective, as well as the long-term liabilities that company has taken in order to invest in the future prospects of the company. So the capital employed is the constituent of two different things, that is non-current liabilities along with the equity that you have invested by your own self. So if I start calculating the asset turnover ratio, I can easily predict 3 lakh rupees divided by 8 lakh 90,000. I'll be getting an answer of 33%, 33.7%, which means I'm rounding it off to 34% of revenue per every rupee of capital employed. Let me write the interpretation of this particular formula. For every 1 rupee of capital employed, the company, remember one thing, you'll always go from the denominator towards the numerator. For every 1 rupee of capital employed by the company is able to generate 0.34 rupees of revenue. Okay, so up till now we have calculated 3 ratios related to profitability of the company, that is return on capital employed. The first formula that we use is the return on capital employed, and it depicted that for every 1 rupee of capital employed that you have invested into the company is able to generate 0.16 paisa of operating profit. A return on sales stated that for every 1 rupee of sales that you made in the company during this current year, you are generating 0.5 paisa of operating profit. Asset turnover ratio stated that for every 1 rupee of capital employed that you have employed in the company, or you have invested in the company in the form of either ordinary shareholders equity or in the form of non-current liabilities, the company is able to generate 0.3 paisa, 34 paisa of of revenue. So we have calculated 3 different ratios. Now coming towards the current ratio, the most easiest ratio, the most prominent ratios, the ratio on which major companies' current liabilities is dependent. Let me calculate the fourth one, that is current ratio. Achha, I'm calculating both these ratios simultaneously, and quick ratio or asset test ratio, because both these ratios are basically associated with the loan giving capacity of the company. So if I calculate the current ratio, you need to use the current asset minus current asset divided by current liability. Let me see how to calculate this ratio. Current ratio is equal to current asset of the company divided by current liabilities. And while calculating the quick ratio, you need to deduct the closing inventory from current asset minus closing inventory divided by current liabilities of a company. So the current asset of the company in this particular scenario that we have been given right now is the current asset of the company constitute 200,000, and the current liabilities of the company constitutes 1,10,000. Let me write the answers. 200,000 divided by 1,10,000. And if I write the answer of 200,000 minus the closing value of closing inventory. So what is the value of closing inventory that we are being given right now is 50,000. So 50,000 is the value of closing inventory. Let me deduct the value of closing inventory, that is 50,000, from the current assets value and divide it by 1,10,000 from the current liabilities value. So the answer that I'll be getting is 2 divided by 1.1. I'll be getting an answer of 1.8 ratio 1. Wow. So it's very prominent from this scenario. If I write the interpretation for every 1 rupee of current liabilities that we owe to someone else, for every 1 rupee of current liabilities that we owe to someone else, we have 1.8 rupee of current assets in our company. And if I find out the answer of quick ratio, while calculating the answer of current ratio, the creditors of the company or the person who is basically giving the short-term loans to the company, they won't be reliant on the current ratio. Okay, current ratio is a good ratio, but this cannot be quickly convertible to cash. Now, if let's suppose the company defaults and the creditor is of the view that we need a quickly convertible to cash, we need to find out the quickly convertible to cash ratio. In order to find out the quickly convertible to cash ratio, you need to find the quick ratio. And in order to find the quick ratio, I need to deduct the inventory from current asset and then divide it by the current liability. So I'll be getting an answer of 1.3 ratio 1. One of the most usable ratios in our current scenarios we generally use while giving short-term loans. We generally use these two ratio in order to find out that giving loan to such a company is viable or not. So always remember one thing: we'll be discussing these ratios, we'll be interpreting these ratios from the denominator towards the numerator. So for every 1 rupee of current liabilities that we possess 1.31 rupee of quickly convertible to cash amount. Quickly convertible to cash amount. Guys, we have right now been able to calculate the current ratio, quick ratio. Now let's come to the inventory days ratio. The next ratio that I'm calculating right now is the inventory days ratio. Now, how do we calculate the inventory days ratio? So it's very easy to calculate the inventory days ratio. Inventory divided by cost of goods sold into 365. Remember, this the name suggests it's a days ratio. So we need to divide inventory, that is most probably the closing inventory, divided by cost of goods sold multiplied by 365. So what is the closing inventory that we are being given right now? We have been told that the closing inventory of the company is, okay, so the closing inventory of the company is 50,000. What is the value of cost of goods sold? Oh my God, the cost of goods sold value is also 50,000. So the inventory is 50,000. Cost of goods sold is 50,000. Okay, so I have just now made this question. Obviously, We just need to understand this question from the point of view of calculating the ratios rather than to find out the practical implication, or rather than to find out whether it may be practically implicable or not, multiplied by 365. So it's a very prominent ratio. I'll be getting an answer of 365 days. Maybe we might be selling those goods that may be taken by only one single customer, or we earn the entire profitability by selling only one good in an entire per annum basis. Or maybe we might be a contractual suppliers, the supplier which basically builds up the houses or the offices of a company. We take one particular house, we build it in one particular year, and then we earn. So this is quite prominent, or maybe reliable ratios, or practically implicable ratio. And we can interpret this ratio by saying that every inventory that we hold, it takes 365 days to complete the turnover cycle. Okay, so let me discuss the next ratio that I'm calculating. We have calculated up till now 6 different ratios. Receivable days ratios, very easy ratio. Let me calculate the receivable days ratio. I'm calculating receivable plus payable days ratios. How to calculate receivable days ratios and how to calculate payable days. Receivable divided by credit sales multiplied by 365, and payable days ratio, payable divided by credit purchases multiplied by 365. So in order to calculate the receivable days ratio, that we need to receivables divided by credit sales multiplied by 365, payables divided by credit purchases multiplied by 365. So the receivable amount given in this scenario is account receivable constitutes 30,000 divided by credit sales. Credit sales is 50% of the total sales, that is 1,50,000. So, sorry, I forgot the amount of receivables. I guess it's 50,000. Yes, 50,000 divided by credit sales. It's stated that the credit sales are 50% of the total sales. We have total sales of 3 lakh. So the credit sales are 1,50,000 multiplied by 365. So I'll be getting an answer of 50,000 divided by 1,50,000 multiplied by 365. 121 days. And the payable days ratio may be calculated by using the amount of payables that we are given. So the amount of payable includes 70,000 divided by total purchases is 80,000. And assuming that the entire purchase amount is credit purchases. Sorry, I forgot the payable amount. Payable amount is 70 and total purchases for the year is 80. Let me write all on credit. Okay. So 70,000 divided by 80,000 multiplied by 365. Calculating both these ratios simultaneously will give me a clear edge whether our company is basically struggling to come out of the recoverability element, or our company is in the advantageous situation of paying the amount of money after receiving it from our customer. Let me find out the answer. 70,000 divided by 80,000 multiplied by 365. 319 days. Pause this video for a second and discuss, pause this video for a second and think of the fact that if a company is in the advantageous situation, or is it in the struggling situation? Okay, so according to me, the company is in the advantageous situation. Why? Because the company receives the amount of credit sales in 1 to 1 days or 4 months. However, the company pays its suppliers after 319 days. So the best situation for the company is the company purchases a particular product, sells it to the customer, receive money from the customer, keeps their profitability with themselves, and then return the amount of money that they ought to return to their suppliers. So the company is in the advantageous situation, because if I divide 319 with 30, considering 30 days, assuming 30 days per month, we are basically paying the amount of money in 10 months after 319 days or 10 months. So according to my understanding, the company is in the advantageous situation. Perfect. We have calculated up till now 8 different ratio. Now calculate capital gearing ratio, the last ratio of this question. That is, let me calculate the last ratio of this question and then I'll be ending this class. Capital gearing ratio, which may be calculated using the formula of so the capital gearing ratio may be calculated using the formula of so the formula for calculating the capital gearing ratio. So the capital gearing ratio is calculated by using the formula of non-current liabilities divided by non-current liabilities plus ordinary shareholders' equity. Non-current liabilities divided by non-current liabilities plus ordinary shareholders' equity. So the non-current liability amount that we are given right now is the amount of non-current liability is 200,000 of bank loan that we had taken according to the financial position of this company. 200,000 is the value of non-current liabilities. 200,000 divided by 200,000 plus ordinary shareholders equity. I guess the ordinary shareholders equity amount was 3,90,000. Oh my. So 3,90,000. This gives me an answer of 200,000 divided by 5,90,000. So the answer to this capital gearing ratio is 200 divided by 590 I'll be getting an answer of 33%. Our gearing is 33%. You'll be multiplying this by 100. Our gearing is 33%. So I can interpret this answer by saying that for every 1 rupee of investment, either in terms of non-current or equity, we are using 33% or 33 paisa of non-current liabilities. I hope so that all these ratios have been quite clear to you guys. Make sure that you solve this question by yourself at your home and then come back for the 4th video lecture that I'll be uploading. This is Sheikh Bilal Haq signing off right now. Take care. Allah Hafiz.